All right, future CPAs, let's get into it. Today, we're cracking the code on a topic that is absolutely going to be on your LECPA, operating leverage and business risk. We're not just going to memorize stuff, we're going to master it, so you're ready for exam day and beyond. So here's our game plan for today. First, we'll unpack why fixed costs are such a huge deal. Then we're going to see it all in action with a super clear example. Next, we'll figure out how to find that crucial safety zone, the break-even point. After that, we'll learn how to actually measure the risk. And finally, we'll wrap it all up with a rapid-fire review, perfect for your LECPA prep. Okay, first things first. We got to get to the absolute heart of this topic. Seriously, if you can really grasp this one core idea, everything else we talk about today is going to click right into place. So why do we call fixed costs a double-edged sword? You have to get this. It's the ultimate risk-reward game, right? When your sales are booming, those fixed costs are your best friend. They literally supercharge your profits. But if sales take a nosedive, whoa, that same exact structure can turn on you, and it can turn on you fast. So the official textbook term for this whole thing, it's called business risk. Think of it as the basic built-in risk a company has just by existing, before it even thinks about taking on debt. It all comes down to those costs you just can't escape. Things like rent, salaries, and depreciation. The stuff you have to pay whether you sell one item or a million. All right, so theory is cool and all, but let's see how this actually plays out in the real world. A case study is legit the best way to make this stuff stick in your brain for the exam. Okay, check this out. We've got two companies. Firm F has super high fixed costs. Just picture a massive factory with tons of expensive equipment. Then you have Firm V with low fixed costs. Maybe they just outsource all their production. Now, here's the really interesting part. At the start, Firm V, the safer, low-leverage company, is actually making more money. Okay, now for the fun part. A 50% jump in sales? That's awesome news for any company, right? But you've got to watch how differently this good news hits their bottom line, all because of their cost structures. This is where the magic happens. And boom, there it is. This is the perfect illustration of leverage in action. Just look at that jump. Firm F's profit went through the roof from $1,000 to $5,000. Firm V, yeah, their profit grew, but it's not even close. Firm F, with all those fixed costs, took that sales growth and turned it into a massive profit explosion. So here's the key takeaway, the big aha moment. The exact same 50% sales increase gave the high-leverage firm a mind-blowing 400% jump in profit. That amplification, that magnification effect, that is operating leverage. It's a profit amplifier. Okay, so we've established that high leverage is a high-risk, high-reward game. But how does a manager figure out where their safety net is? Well, that brings us to a classic tool you absolutely 100% need to know for the LEPA. Break-even analysis. This graph pretty much says it all. You see this point right here, where the total revenue line crosses the total costs line? That is your break-even point. At that exact spot, you're not making money, but you're not losing any either. For your exam, knowing how to calculate this is non-negotiable. You gotta know it. And here it is, the formula you need to burn into your brain. It's your total fixed costs divided by your contribution margin per unit. And what's that? Well, it's just your selling price minus your variable cost per unit. Super simple. This tells you the exact number of units you need to sell just to cover all your bills. Okay, so now we get the idea, and we know how to find our safety zone. But how do we actually put a number on this risk? Like, how risky is it? That's where something called the degree of operating leverage, or DOL, comes into play. So there are two ways to look at DOL. The first one is what I call the concept formula. It's the percentage change in your operating profit, or EBIT, divided by the percentage change in sales. Just think of it like a sensitivity score. It tells you exactly how much your profit will jump, or fall, for every 1% change in sales. Now, if we plug in the numbers from our two firms, it all makes perfect sense. Firm F had that huge 400% profit change from a 50% sales change. You do the math and you get a DOL of 8. What does that mean? It means for every 1% change in its sales, its profit moves by a massive 8%. Compare that to Firm V, whose DOL is only 2. Okay, so that concept formula is great for understanding. But for the actual SCPA, this right here is your go-to. Your shortcut, this is the one you'll almost always use on the exam. It gives you the exact same answer, but you don't need any of that before and after data. You just take your contribution margin and divide it by your EBIT. Boom, done. So let's prove it. Let's run the numbers for firm F back at its original sales level. First, you get the contribution margin. That's sales of 10,000 minus variable costs of 2,000, which gives you 8,000. Easy. Then you just divide that by the EBIT, which was 1,000. What's 8,000 divided by 1,000? It's 8. Look at that. The same exact result, but way, way faster. All right, let's bring it all home and lock in this knowledge with a quick review. This is your ultimate study hack for the exam, so get ready to screenshot this slide. Okay, these are the non-negotiables, the core definitions. Your mission, should you choose to accept it, is to know these so well you could recite them in your sleep. Seriously, this is pure exam gold right here. And here are the weapons for your arsenal. These are the essential formulas. I want you to write them down, make flashcards, do whatever you gotta do. Practice them over and over until it's just pure muscle memory. You don't want to be thinking about the formula on exam day. You just want to do it. All right, to finish up, let's see what you've got. Here is a classic LECPA style problem. Go ahead and pause right here, grab a calculator, and use that calculation formula we just covered. See if you can nail it. This is exactly the kind of thing you're going to see. Keep practicing. You've got this. Good luck on the LECPA.